7 Assets the middle class needs to build real wealth. Building lasting wealth isn't just for the ultra wealthy. With strategic planning and consistent action, middle class families and individuals can create substantial wealth over time through 7 critical assets. Here's your roadmap to building sustainable wealth over the long term. 1. Turn your home into a wealth building engine. Homeownership remains the cornerstone of middle class wealth building for good reason. When you make mortgage payments, you're forcing yourself to save by building equity. Unlike rent payments that disappear forever, each mortgage payment increases your ownership stake in a valuable asset. Savvy homeowners maximize this wealth building potential by making strategic improvements that increase home value without over-improving the neighborhood. Consider house hacking strategies like renting out a spare room or basement apartment to offset mortgage costs. The key is keeping your total housing costs below 28% of your gross monthly income to avoid becoming house poor. First-time buyers should explore FHA loans and other programs designed for middle-class home buyers. These programs often require down payments as low as 3.5%. Buy a home in a growing quality neighborhood, within driving distance to great jobs, and in a good school district to ensure home value growth into the future. Once you've built equity, you can leverage it through a home equity line of credit for emergencies or investments, though this strategy requires careful consideration. 2. Supercharge your future with strategic retirement accounts. The path to retirement wealth starts with understanding your options. Traditional 401ks offer immediate tax benefits by reducing your taxable income, while Roth IRAs provide tax-free growth for retirement. The real power comes from employer matching. If your company offers a match in their company-sponsored 401k on the first 6% contributed, that's an immediate 100% return on your investment that most employees are missing. A well-diversified investment portfolio acts as your wealth-building engine. The foundation should be low-cost index funds that track broad market indices. These provide instant diversification and historically strong returns without the high fees of actively managed funds. Your investment mix should reflect your age and risk tolerance. A typical starting point is subtracting your age from 110 to determine your stock percentage, with the remainder in bonds. For example, a 35-year-old might hold 75% stocks and 25% bonds. Regular rebalancing keeps your portfolio aligned with your goals while managing risk. Consider this: contributing $500 monthly to a retirement account and earning an average 7% annual return could grow to over $871,512 in 35 years. Start early and maximize your contributions whenever possible. If you're starting later, take advantage of catch-up contributions allowed after age 50. The optimal strategy often involves dividing contributions between traditional and Roth accounts to create tax diversification in retirement. Aim to increase your contributions with each raise, directing at least 50% of any income increase toward retirement savings. 3. Invest in the stock market with a diversified investment strategy. Building a robust individual stock portfolio outside retirement accounts requires strategic thinking and disciplined execution. While index funds provide a solid foundation, carefully selected individual stocks can potentially enhance your returns and build significant wealth over time. Start by allocating a portion of your investment capital to established, dividend-paying blue-chip companies. These industry leaders often provide steady growth and reliable income through quarterly dividend payments. Companies with decades of consecutive dividend increases, known as dividend aristocrats, can form the backbone of your portfolio. Complement these stable positions with growth stocks with solid fundamentals and competitive advantages in expanding markets. Look for companies with healthy balance sheets, increasing market share, and sustainable business models. Tech giants, healthcare innovators, and emerging industry leaders can provide significant appreciation potential. Diversification is crucial. Spread your investments across different sectors and market capitalizations. A well-balanced portfolio might include 15 to 20 stocks in the technology, healthcare, consumer goods, finance, and industrial sectors. This approach helps protect against sector-specific downturns while capturing economic growth opportunities. Many brokerages now offer fractional shares for new investors, allowing you to begin investing with as little as $5. This means own portions of high-priced stocks like Berkshire Hathaway without committing thousands of dollars. Create a regular investment schedule, weekly, bi-weekly, or monthly, to take advantage of dollar-cost averaging and avoid the pitfalls of trying to time the market. Consider implementing a position sizing strategy in which no stock represents more than 10% of your portfolio. This helps manage risk while allowing your winners to run. When a position grows beyond your predetermined threshold, rebalance by taking partial profits and reinvesting in new opportunities or underweight positions. Risk management is essential. Set straightforward buy and sell rules based on both fundamental and technical factors. Use stop-loss orders to protect against significant downside, but place them wide enough to avoid being shaken out of good positions by average market volatility. Keep detailed records of your investment thesis for each position and regularly review whether it remains valid. Before adding any stock to your portfolio, conduct thorough research. Analyze financial statements, understand the company's competitive position, and evaluate management's track record. Pay attention to valuation metrics like PE, PEG, and free cash flow yield to avoid overpaying for growth. Track your portfolio's performance against relevant benchmarks like the S&P 500. While short-term underperformance is not unusual, consistent long-term underperformance might signal the need to reassess your strategy. Stay informed about your investments through company earnings reports, industry news, and market analysis, but avoid making emotional decisions based on short-term market movements. Consider using a portfolio management tool to track your investments, monitor diversification, and analyze your returns. Many brokerages offer these tools free with your account, helping you make data-driven decisions about your investment strategy. Remember, success in individual stock investing requires patience, discipline, and continuous learning. Start small, focus on quality companies you understand, and gradually expand your portfolio as your knowledge and confidence grow. The goal is to build a diversified collection of high-quality companies that can compound your wealth over decades. The key is consistency. Set up automatic investments to remove emotion from the equation and benefit from dollar-cost averaging. 4. Build your financial safety net through emergency savings. An emergency fund isn't just savings, it's wealth protection. Without this buffer, unexpected expenses can force you to take on high-interest debt or raid retirement accounts, destroying the wealth you've built. Aim to save 3 to 6 months of essential expenses in a high-yield savings account. Start by saving just 1 month of expenses, then build from there. Direct deposit automation makes this easier. Automatically transfer 5 to 10% of each paycheck to your emergency fund until you reach your goal. Keep these funds accessible but separate from your regular checking account to avoid temptation. Having an emergency fund as an asset can provide the safety net you need to make a career change and be more self-insured for small expenses. 5. Invest in yourself. The power of education and skills. Your earning potential is directly tied to your knowledge and skills. In today's digital economy, continuous learning is non-negotiable. Focus on developing high-demand skills in your industry through certifications, workshops, or online courses. Platforms like Coursera, edX, and LinkedIn Learning offer professional certificates at a fraction of traditional education costs. Many employers offer tuition reimbursement programs. Take advantage of these opportunities to increase your value in the marketplace without taking on debt. Generally speaking, investing in yourself is the best thing you can do. Anything that improves your own talents, nobody can tax it or take it away from you. They can run up huge deficits, and the dollar can become worth far less. You can have all kinds of things happen. But if you've got talent yourself, and you've maximized your talent, you've got a tremendous asset that can return tenfold. Your knowledge, skills, education, and experience can be your greatest asset not found on your accounting balance sheet. 6. Create wealth through business ownership. Starting a business doesn't always mean quitting your job and risking everything. Begin with a side hustle in your area of expertise. Digital companies like consulting, online courses, or e-commerce stores can start with minimal capital and grow gradually. The key is identifying a profitable niche where your skills meet market demand. Test your concept with minimal investment before scaling. Many successful businesses start as weekend projects, growing into full-time enterprises only after proving their viability. Many self made millionaires took the fast track to a 7-figure net worth by building a business as an asset. 7. Generate passive income through real estate investments. Real estate investing doesn't require millions. Real estate investment trusts, REITs, allow you to invest in real estate with as little as $100. For direct property ownership, house hacking can be an entry point. Purchase a duplex, live in one unit, and rent out the other. Successful real estate investors start small, learn the market thoroughly, and gradually expand their portfolios. Consider partnering with other investors to share costs and risks. If you prefer a more passive approach, property management companies can handle day-to-day operations. Conclusion: building real wealth requires a multifaceted approach, combining these 7 assets strategically over time. Start where you are with what you have.